Hello everyone, welcome back to my channel. So this video has been due to be recorded for a few days already. This is an important one to make because I believe that all the ordeal around Estée Lauder that we've been through is important for us to look back and see what has been done wrong and what actually what can we learn from it so that we can move forward and avoid these mistakes in the future. And this is something that I want to talk about because this can be useful also for anyone who is willing to begin his journey on options trading. And so we're going to go through with these mistakes, and I'm going to make sort of an overview of what happened and all the steps in sequence, in chronological sequence, to make sure that everyone is really has a really clear view of basically what went wrong and how mistakes basically compounded on top of mistakes. And for the purpose of this video, I reviewed all the information about the trades that I did, not only from the scoreboard that we have been also keeping over time, but also through the account statements, the daily account statements that of course our broker uses and provides to the traders. And so basically looking back, I saw that there are basically four pretty glaring mistakes that we did, and I want to basically talk on those on chronological order for you to understand, all right, how can those mistakes basically compound and make the situation worse and worse. And so basically the first mistake that I believe it was committed by me was basically that we assumed the risk of having or holding a oversized position if our put options, let's just say our short put positions are assigned, meaning because we are selling puts, of course, if the price falls below the strike, the puts go into the money and the put buyer will sell the underlying shares to us at the strike price. And so basically this was the first mistake. Why do I say this? Because this is our scoreboard, as you can see, and if we filter for the Estée Lauder trades, which is right here, you will see that the first few trades took place on July 17th and July 18th. So we put ourselves in a position to buy 300 shares. This is, of course, we just treat this as a single trade because this was done on consecutive days. They are the same option, and we put ourselves in a position in which we had to buy 300 shares at $100 a piece. So this would be in total 30,000 euros if we were assigned. And so if we consider that these 30,000 euros in the context of our portfolio or the size of our portfolio at the time, and I have the activity statement right here from July 17, you will see that at that point, on that particular day, we had a size of the portfolio which is around 95,000 euros, and we have a cash position of around 61,000 euros. And so if we pull up a calculator, you will see that basically we are consuming basically almost a third. Let's just put it 95,000. It's almost a third of your portfolio being occupied or consumed, or having a position of a third of the size of your portfolio just in 300 shares of Estée Lauder. And this was a mistake, because if we are called away, if we are called, if we have the shares put to us, so we are forced to buy those shares, we end up with a very sizable position, which is not comfortable, because it takes a lot of flexibility out of the portfolio and makes the portfolio very, very volatile when these positions change prices. And so as this happened, and so this can make, and eventually made, this can make our portfolio very concentrated in a single stock, all right, and extremely sensitive to price changes in that stock. All right, so this is not good. This is not proper portfolio management at the time, because I mean myself, I thought, and I still think, that it's a very high quality stock, despite the difficulties that have been going on the past few months, or even the past year, with the company. The brand value, the size of the company, the range of products that it sells, I believe it's a true winner. It's going through a rough patch at the moment, but all the potential is still there, and I have no doubt that the company will eventually turn around and continue on a path of continued growth and sustainability of its business. So that is not in question. The question is that you become very, very dependent on the changes of what happened to that stock. The ups and downs of that particular stock become very, very important for you, and your portfolio depends heavily on those fluctuations. And this is not good from a perspective of sensible portfolio management. And so this was the first mistake that we did, but this was done, and after this was done, we were left with about a third of our portfolio with just occupied by this stock. Then the second mistake comes when we basically traded some more options on this particular stock. And so you can see right here that the second time we were assigned, this took place on the option that expired on August the 2nd, and we took a short position on a put, a cash covered put with a strike price of 96, and we sold 3 contracts. So we were liable to buy 300 shares at $96 a piece if the stock price fell below the $96 by August the 2nd. And so we took this position on July 29th, as you can see. And so if we look at this particular day, we still have around 103,000 or $104,000 in terms of the size of our portfolio, and we have about 54,500 in cash. And so if you consider the size of this new shares, and as you can see, it's $96 times 300 shares, this will be 28.8. And if you think about it, because you already paid 30,000, all right, in shares, with the first batch of 300 shares that you bought, you will end up with a position with the cost basis of 58,800 euros, which for a portfolio size of, let's just say it's 104,000, this is more than half of your portfolio. So this compounds even further. And not only that, you are doing this trade, all right, and you are occupying this, you are at risk of occupying your portfolio, more than half of your portfolio with a single stock. So you are basically, we increased, or we put ourselves at risk of inflating the size of the position even further to more than half of our portfolio, right? And another thing that we did is that, but yeah, we'll leave that for the third reason. So this compounded the mistake even more, all right, because if the shares were assigned, and as you can see, if the puts were assigned, and eventually they did, all right, the situation, it becomes even more serious when it comes to the sensitivity of your portfolio to the price changes of this particular stock. I know that the premiums were very good; they were rich in comparison to the price of the shares, but still, it's not worth the risk. All right, even when the premiums, and this is an important point to make, even if the premiums were very, let's just say, juicy, and the stock was a high quality one, the associated risk that comes with a very oversized position far outweighs its benefits. All right. So basically, no matter if the stock is the best stock in the world, all right, but as long as you have such a concentrated position in your portfolio, this is not good for the long run. You may feel that, all right, the company is good, so the prospects are good. The stock, even though it may have a dip, always come back. Yes, but you never know what's going to happen, all right, and you become too dependent, and if something happens and you need to downsize the size of your portfolio, you become very dependent on where the price of this particular share is. Whereas if you have a bunch of small positions, it's much easier for you to manage which shares are you going to sell. You can even dispose of an entire position which is going to be very small. It's going to have a very low impact on your portfolio, and on the other hand, if you try to dispose of a very large position such as this one, you run the risk of the slippage of the market, resulting in you having to sell, especially when stocks are a little bit more illiquid, which is not the case here, but you run the risk of having to sell at a much lower price than the price is actually quoting. So this is definitely not worth the risk. For the third mistake, and this was a mistake that happened twice, one of those in this particular trade that we talked about in here. This mistake was made twice. This was made here because, as you can see, we had before we entered into this trade, right? We had only one position, which is trading at 100. All right, we basically bought the stock at 100, And because we sold puts on Estée Lauder with a strike at 96, we know for sure, I can't remember the price at that time, but we know for sure that the price was between 100 and 96, because that's the only reasoning behind having sold puts with a strike price. And so the stock could be around, I don't know, 98, 97, 99, around that. So as you can imagine, if you are looking to increase the size of the position, even with the intention of lowering the average price, you must keep in mind that you are just trying to buy a position and acquiring more shares at a price which is only 4% below the price, your current average cost. And so this happened in this particular situation. This is a glaring mistake because as you can imagine, if we want to lower our average price so that we can avoid a capital loss when selling the entire position, we must try to acquire more shares when their price has gone significantly lower than significantly, yeah, this is correct, I think. Oh, significantly, yeah, all right, whatever. Then your a mistake. Then your cost base. And what I mean by significantly lower, it can be even 15%, 20% and beyond. All right, not, or definitely not 4% as we did on July 29, right? And not only we did this, the puts were assigned to us. We had to buy them at 96. So with 300 shares at 100 and 300 shares at 96, our cost base went to 98. All right, but then we did the same mistake again later on in the last day of September, as you can see right here, because then we sold two more puts with a strike of 97. So this means that the price should have been around 98, something like that, because otherwise it wouldn't make sense for us, or even, I don't know, close to 100, probably. It's more likely to have been around the 100. We tried to sell, we sold two contracts at a strike price of 97, so we put ourselves in a position to buy 200 more shares at 97. So as you can see, this mistake compounded or was repeated when at a cost base of 98 US dollars, we put ourselves at risk of buying 200 more shares at 97. all right, at 97 USD. And this, if the shares were assigned as they were, as you saw, were assigned as they were, our cost base went down, if I'm not mistaken, to 97.75 USD. Let me just confirm, because I think that was the case. So if we had a cost base of 98 times 600 shares plus, with the parentheses, so it was 2 contracts times 97, close, and we divide this by 800 shares. Yes, so this would be a cost base only came down by 25 cents. So only cost base only came down 25 cents, which is absolutely ridiculous. It makes absolutely no sense at all. All right, I remember that in this situation I was quite taken away because of the premiums. The premiums that were available were very good. All right, but in the end, you must consider the fact that if we look also at the activity statement for September the 30th, we had a position, a size of the portfolio of around 131,000. All right. Our stock position was 80,000 in total, but we had more shares. But as you can see, we had at that time a position of 58, if I'm not mistaken, 58,800. So by buying 200 more shares, and this was what we had at the time, if we buy 200 more shares at the price of 97, right, this would bring us to a portfolio size of 78,200 euros, dollars. And if you divide by 131,000, give or take, because that's the size of our portfolio at the time, again, from, if you remember, 56.5 on July 27th, we would go, this position as a whole would have a size of around 60%. So it goes more towards 2/3 of our portfolio than the half of our portfolio. So this was a glaring mistake that was repeated twice. It was done twice, and this is really shooting yourself in the foot and putting yourself at risk of something going very wrong. Because at the end of the day, you keep accumulating shares, you are making no significant dent on the cost base, and you need to sell the shares. At some point you need to sell the shares because you cannot continue to buy anymore. All right, and so this was a mistake that of course happened twice. Now the fourth one, but here it's a different type of mistake because it's just a lapse of attention which happened here. This trade that we did on October the 28th, and this was only lack of attention. All right, simply as that, lack of attention, as I thought that Estée Lauder earnings would only be released in the following week, but they were actually due to be released on that exact week. And so by selling puts at with earnings release before their maturity, you are at mercy of a large price swing going against you. And this was exactly what happened. All right, let's just delete some of these things here so that you can see clearly, because as I already explained, when you are selling options, all right, you are putting yourself, you are betting on low to no volatility at all. If you are under a high volatility environment, you are much more exposed to the possibility of the options, being puts or calls, whatever, being assigned, all right, being exercised. And in this case, yeah, it worked completely against us, because the stock dropped about 20% from my guess is it was around 87, 86, and it just dropped to 60, 65, 64, something like that. So it dropped around 20%, and you just couldn't do anything about it. And the thing is that, as I recall, the earnings were released on October the 31st, which was a Thursday, and because we are trading American options, all right, I recall that, and I know that, and I also mentioned that in one of my previous videos, after the stock dropped 20%, the very next day the put buyers exercised those puts immediately. This is not actually correct. So because they exercised, they were immediately exercised on that day. So I was forced to buy 400 shares at 82 USD a piece before the next day. All right. This is how catastrophic it can be, because we are talking about American options, and these can be exercised before the maturity. This next day would be the maturity date, but they decided not to wait for the maturity. They simply exercised the options, because the options were so much in the money, and they felt, yeah, the stock is not returning to 82, is way too below that. It was around 65, 64, so there was no reason for us to wait any longer. We are just going to exercise, receive our $82, and give back the shares, which are now valued at 64, 65. So it was a very, very easy decision for the put buyers, and so I was forced to buy the options, to buy the stocks because of that. Now, these were the mistakes, all right, and once we got in this position, of course we had to get out of it in some way. But as you can imagine, this was not easy at all, and we were still hanging at the average price of around, if I am not mistaken, this was 78. this was the size of the position before, so more 82 times 400, so we end up with a position of 111,000. If we divide by 1200 shares, basically this was our cost base after we bought these shares at 82 at 82. And so given this situation, the price was trading at 64.65 and we had a cost base of 92.5. We basically were in the deep hole, and we had to try to come out of it. And this is what I'm going to explain now, because this of course involved difficult decisions, but I want to talk about those for you to also have an understanding of how we managed to get on top of this. And so my reasoning behind it was because, as you know, we decided after, so with the cost base of 92.50 USD and the stock trading at around 64 or 65 USD, we decided that we had to buy all the shares we could at around those prices, so that our cost base could significantly, yeah, that's correct, come down. Now, this is not easy. And why it's not easy? Because you get a psychological blow by seeing your stock coming down 20%. And remember, this was around 2/3 of our portfolio. All right, so this was serious stuff from a psychological perspective, because basically you see a big chunk of your portfolio being simply disappearing. And so you need to get the mental fortitude to buy more shares of a stock that has basically been torn apart. All right, so but why is that? Why did I make the decision? Because my reasoning, and of course we cannot predict the future, but we can imagine. My reasoning was basically this: if before the 20% drop, the stock, if the 20% drop was justified, all right, was justified, and that means that the stock was actually worth around 64 or 65 USD. That means that the day before earnings, the stock was completely misvalued. All right, because nothing in the company, nothing fundamental, nothing in the company fundamentals changed in between the day before and the day after earnings, right? So I did not believe that the stock was completely misvalued before the earnings. So this 20% drop had to be, in my view, the plunge, the 20% plunge had to be nothing more than a psychological response to what came out of the earnings, meaning guidance was withdrawn, the earnings guidance for 2025 was withdrawn, the revenues came down about 5%. The adjusted earnings, so without one-offs, which is what matters the most, without one-offs, increased. So with this particular prospect, I felt, all right, this was nothing more than a reaction than the earnings guidance being withdrawn. This was the most important factor, because basically the company said to investors, all right, we don't know, we are not sure what's going to happen in 2025. So the earnings guidance we had for 2025 up until this point is going to be scrapped, and we're going to have to think about a new one as we get new information from the business. And this was the biggest factor that led to this drop. And so, yeah, but that doesn't mean that the company value should have dropped 20%. All right, so I followed my gut feeling that this could not be a realistic valuation, and because of that, I just had to put the fears aside and start buying all the shares that we could while the price was that low. And that means that we basically had to buy all of these shares. So if we sum these up, this comes to 1100 shares that we bought at around this price: 67, 65, 64, 64, 64, 65, 63, 68. And now when the price started to recover, we even bought some at 74, 75. So this was basically what we had to do to lower our cost base. And as you can see here in the legend that we did here in the notes, we managed, at the time of the selling of the entire lot of shares, we managed to bring our price down to $79.88. And remember, we did it from 92.5, and because we bought these 1100 shares at these prices, we managed to bring it down by almost $13 a share in our cost base. So this is basically what we had to do. We had to think, all right, after a 20% plunge, the stock is misvalued now, must be misvalued now, and is for sure it is cheap, and we need to make the most of this particular time when the stock is at a very, very low level of price. And so if we come back here to our platform here, let's see. So for some reason I cannot select. All right, now we can. All right, so basically if we pull back the chart of Estée Lauder, we are able to see here, and the stock is trading at 79.81, so we actually did quite well in managing to sell at $82, as we recall from previous videos. I have no idea why the chart now is taking so long to load. Let's see if the option chain is available. It is. Alright, for some reason this is not cooperating with us, so probably we'll have to find another solution, because it's not giving us the information we want. Right, so let's just try something different. Stock graph. And so as you can see here, so 1 month, actually 6 months. So after this 20% plunge here, we had to make the most of the time in which the stock was right here. All right, and so we had to buy all the shares that we could at this particular spot, so that then when the stock started to rise here, it didn't need to come back to the initial price, so that we could already be holding the shares with a capital gain. And so by this time we decided, all right, we are not going to, because we needed to buy as many as possible in here, the decision had to be, it had to be this way, because we simply had to outright buy the shares. Let me just put this in here to explain why is that. All right, so given our need to buy all the shares we could at very low prices, we could not sell puts and wait for them to reach maturity and being or not being assigned to us, because if we waited, the price could have recovered, as it did, and this is important, as it did, and we as it did, without us having made a dent in our cost base, right? And when I say a dent, significant dent in our cost base. So because of that, we had to buy shares directly, all right, in order to make the most of the price dip. This was very critical for our ability to get out of this. And so when the price started to rise again, we felt that all right, that by this point we already brought down to close to $80, and so by this point we can start thinking on selling if it comes back to 80, because it was possible. It was not our initial point, and so by doing that it was very much realistic that this could happen, and it ended up happening much sooner than, at least in my view, I would expect, because the stock simply started to rise quickly, right, and recover, and much quicker than I expected. And even at the point of when we sold this call, all right, at 80, for a moment the stock even traded above 80, but then had a pullback and finished the week below 80, so this option expired worthless. But nonetheless, it was a sign of the things to come, because as you see here, on December the 6th, around December the 6th, we were here, and so we were very close to 80, and then when they simply came to over 80, we took the chance, and we did not sell any calls, all right. We simply sold the shares, because there is no point waiting, because you cannot this is something that is very bad. If you keep holding the shares for this long, you just need to dump them as much as possible. You forfeit the premium because you're not receiving any premium for selling the shares directly, but still it is, for me, in my opinion, the most critical step, the right way to do it, because options require you to the strike price for options to be in the money at maturity. Because you are the seller, you cannot exercise early, only the buyer can exercise early, and so if you are the seller, you are at the mercy of the buyer exercising earlier or not, and he has no reason to exercise if the option is out of the money. But when the option are in the money, you can only benefit when it is at maturity, so you cannot wait. And the price, if we had waited, the price would have come down and the calls would be out of the money, and we have still kept the shares. This is no good, so we might as well simply sell them directly, as we did. As you can see right here, we sold them directly, and that's when we made our profit and we managed to get out of this situation. So now at this point, the stock probably will not get back anytime soon to 90 or 100, because as we stand at this moment, there is still no guidance for the earnings for 2025, and we will have to wait and see what happens in that regard. But by this point, we are already out of the position, and we ended up with a nice profit. But again, it took a lot of stress, mental fortitude to buy shares after a 20% plunge. But in the end, something was amiss. It was not something was not correct with the valuation, and so the price could not simply be inaccurate, completely way off before the earnings, and now after earnings it is correct. No, it is much more likely that, given the earnings release, the results of the earnings release, the shares were now right after earnings were misvalued, and so they had to come back at least by a little at that point. And so they came by a little, by some margin, from 64, 65 to 80, and we took our opportunity to lower our average price while we could, and then at a small recovery, we ended up coming out of the trade with a profit. And so basically this is it. Yeah, it's a saga that we hope it won't happen again. But I hope that this will also serve as a lesson for everyone who is trading options and is making these mistakes, because it's certainly helped me as a trader, and for sure I will be on watch to make sure that this doesn't happen again. Just one last remark, because I know that at this point we are basically increasing our position in Ford Motor Company, all right, and now the graph is working again, but we are now working on increasing the size of our position at Ford Motor Company and Pfizer as well, and we are now with a cost basis of Ford of around $9,346 dollars. But keep in mind, of course, it's a large position, a relatively large position, but we have to keep in mind the size of our portfolio. And currently we have a portfolio of around 196,000 euros. So if you make the calculation very briefly between 9,300 and 196, this is only 4.7% of our entire portfolio. And so because we are doing this just for the sake of lowering the average price so that we can sell, and the stock had an average price of $13 and 36 cents, as you know from the previous videos. We now bought more, 400 more at the price of 10.5, and so if you see the price difference between the price we bought the new shares and the old cost base, so it was around 13.36, something like that, we see that the price is down by around 22%. Just do it this way, 21.4%. So it's a much bigger depreciation. So it makes sense for us to do this, because any shares that we buy will significantly lower our cost base. In this case, it helped us to come down from $13.36 to $11.93. So now we can sell call options at 12 with a strike price of 12 and try to get rid of the entire holding altogether. And so basically this is it. Feel free to leave your comments and any questions you have in the comment section below, or you can also address those to me through a DM on LinkedIn. And of course, feel free to like the video and subscribe to the channel. Any further remarks that I may have on the trading and all that, I will either address those on the weekly videos, or I will make another one for you guys to stay updated on how things are going. And yeah, I'll see you all in the next one.